Welcome to Hedge Interview. I'm your host, Jennifer Bruno, and today I'm speaking with Eric Munson. Eric is the co-founder and chief investment officer of ADIT Ventures, a family office-owned late-stage venture firm based in New York with offices in the San Francisco Bay Area. Eric co-founded ADIT Ventures in 2014 at the request of family offices seeking to obtain shares in late-stage venture-backed growth companies. His family office owns equity in more than 20 privately held companies. With 35 years of investment industry experience, Eric has worked in alternative asset management, corporate finance, mutual funds, private equity, venture capital, and growth equity. He has created, developed, and managed over 20 funds while raising assets in excess of $20 billion. Eric has served on the executive, investment, and management committees at reputable firms including Hembrecht & Quist, Morgan Stanley, Franklin Templeton, Seneca, Wentworth Hauser and Violic, and Acorn Partners. He has invested as a principal in more than 40 privately held companies. He has worked on 250 IPOs and hundreds of other deals. Thank you so much for joining me today, Eric.
Thank you, Jennifer. It's a pleasure to be here.
Thanks. I understand that collaboration and co-investment is a growing trend among family offices. Tell us how that trend played into the formation of ADIT Ventures.
Yeah, really, ADIT Ventures developed as an outgrowth of my family's investment practices. We started purchasing shares in privately held businesses when we realized that much of the value creation was happening when companies were still privately held rather than in the public markets. When I started my career at Hembrecht & Quist many years ago, much of the value of the company was being created in the public markets. They would go public at a modest, small capitalization of 200 or 300 million. As their products became more accepted and their revenues increased, the valuation of the company would increase, and the public market investors participated in that value creation. Today, companies are taking much longer to go public, 7, 8, 10, 12, 15 years in some cases. And so much of that value creation is happening in the private markets as the venture capital growth equity markets have evolved.
So do you think that waiting period has extended, the pre-IPO period has extended because there's so much more investment opportunity beforehand instead of the public markets?
Well, I think there's a couple of reasons for it. Yes, there is a lot more capital in the private markets than there was even 10 years ago. You can look at the growth in the New York venture capital community as examples of that. Tremendous amounts of growth in the private capital markets, be it for early stage, be it for BC/D rounds and middle stages, or the later stages where we typically invest. So that's part of the reason. The other part of the reason is that companies, when they do go public, want to be at a critical mass, and they want to have a bulletproof kind of story. We've seen that trend accelerate recently with much more of a value focus versus the growth at any cost kind of approach that we've had in the years past. So I think when companies do in fact go public, companies like Alibaba going public 6, 7 years ago, they had a very strong business model with a very robust revenue growth and very strong fundamentals. And in that sense, they were ready for prime time in the public markets and were able to withstand the scrutiny. And
Right.
I think more companies are waiting longer to do that.
What's changed in the dynamics of the capital markets that's allowed them to obtain more capital pre-IPO?
Well, you've seen a tremendous increase in the number of venture capital firms and the amount of capital invested in venture capital. You've seen a tremendous amount of increase in the monies invested in other alternative assets, private equity, buyout funds, alternative lending strategies. So there's a much more robust private market network than there was 10 years ago, perhaps as much as 10 times the amount of capital available for companies. And so I think that's a major trend. I think that companies are staying stealth longer and not having to disclose all of their proprietary technologies, their customers, their revenues, their earnings, and are therefore able to hopefully surprise the competition and be able to come out of the blocks and be very effective in terms of executing their business models.
It's interesting, for those of us with a few decades of experience in the financial markets, to see the financial markets mature in certain ways and see how things evolve. Having been in the hedge fund industry, that's evolved tremendously in 20 years. So it's
Absolutely.
equally interesting how, the venture capital markets have evolved as well in this way. So how does being a family office investor make ADIT different from other VC firms?
Well, we like to look at the table as being a round table. It goes back to your first question, is how do people work together? And we really like to work with other families, many of whom bring in expertise in certain areas, industries, geographies. We have families from all over the world who invest alongside us. But one of the things that we've retained is the fact that we make it a round table, and we invest in every single deal we do, my partners and I, right alongside our other family investor partners on the identical same terms and conditions. So we eat our own cooking. We make sure that we're constantly looking at what we're doing, and it's very important for us. The majority of our net worth is tied up in our deals, in our investments, in our firm. And we try to treat every investor and every client company, frankly, as part of our extended ADIT family. We take it very seriously. And I think that that's a really important differentiator than many of our other competition. We're not just trying to make a transaction happen here. We actually invest in the stock. We live with that stock. We live and breathe. We publish quarterly reports on it. Every single news article that comes out about Palantir, about SpaceX, about Airbnb, those articles come to us. We then put them up on our website. We publish quarterly commentaries, monthly sometimes if there's a lot of news happening on a particular company, and try to share that information and knowledge with all of our investor partners. And we also lean on them for ideas and investment themes. But that's the way in which we try to communicate and share our ideas. And there's not a lot of firms out there who do that in our space of the late stage companies.
I would think that being a family office or evolving from a family office, that your relationships with your fellow investors must be deeper and different in that sense from other VC firms, that you have probably longer standing relationships with the investors that you co-invest with.
Yeah, it's an interesting part of the model in the sense that we're working with people, having been in the business now since the 80s, my partner as well, many, many years. It's really a pleasure to work with people who you've known, and now we're actually working with their children, in some cases, the next generation, some cases 3 generations of families. And it's really nice because you get different perspectives from different generations. The millennials and the Gen Xers and the whatnot may have a different approach than the baby boom generation does. And then the patriarchs of some of these families may be, again, 20 or 30 years older, and they also have a unique perspective on investing, on the trends we're seeing. ADIT sort of begins our process. One of the questions you'd asked me previously was, how do we begin the process of finding our kinds of companies? And really what we're trying to do is capture these long-term secular trends that are profoundly changing our society, our world, our economy, and our capital markets, as we talked about a few minutes ago. And those long-term trends, things like artificial intelligence, big data, cybersecurity, the cloud, the Internet of Things, the shared economy, digital healthcare, quantum computing, all of these things, the new media, virtual reality, altered reality, all of these things have been sort of concepts and terms, almost like watching the Jetsons cartoons, but they're now actually really happening in society. We're going to have autonomous vehicles driving people around here. It's happening right now in selected markets in the United States. It's going to be happening all over the world in the next quarter or two. Drone deliveries, which were simply a fantasy out of a science fiction novel, are actually occurring right now. You've got autonomous vehicles right now operating mines for BHP Billiton, and they're taking the raw materials from the quarries into the crushers. And the people who used to drive the trucks are now almost like playing video games, operating these trucks autonomously. The digital healthcare things that are happening. If I unfortunately have some kind of a malady, the doctors can then take my cells, examine my blood type, examine my digital DNA characteristics, and identify the things that I need. They'll take some cells out, they'll mix up some other things in those cells, re-inject them into my body, and help my body heal itself rather than taking an outside chemical or chemotherapy or radiation therapy, things like that. So there's so many changes that are happening across society, across so many sectors of the economy. And we think we're at a really exciting point in terms of change, in terms of actually the potential being realized for companies being more productive, individuals being more efficient, being able to experience things and interact with computers and all the data points we're getting and use this technology, be it AI or machine learning or deep learning, and apply that in their lives, be it in the security of their home, their family, be it in security of their digital data, be it in their productivity of everyday lives in terms of getting to and from work or getting information out about their firms or their businesses or their services they're providing. So we're really excited about the opportunities ahead. I think we're going to see, in most people, conventional wisdom is that the last 10 years have been so great. It's the fourth best decade investments in history. And oh my gosh, the world's coming apart because there's too many people, there's population pressures, there's environmental pressures, the economy, things like that. We take the opposite view, that maybe the next 10 years will be better than the last 10 years because there's so much potential to become realized and because people are aware of some of the challenges we're facing, be it about sustainability or the environment or governance or some of the other issues which are really material to us. But we're super excited about the decade ahead. It's going to be a really exciting time to be an investor, to be a citizen of the world, and to watch some of the potential become realized.
There are so many interesting developments. So how did you choose those particular themes, big data, AI, healthcare, shared economy, and new media? You have so many new developments. How do you, is it a matter of that's your specific area of expertise is in those particular themes? Why those in particular?
We sort of feel as those themes get to the essence of the human experience, be it in society, be it in geopolitical realm, be it in economic terms, be it in the quality of life. And we think that these kinds of themes will really make an impact on people. There are a lot of other themes out there, the rise of blockchain technology and the cryptocurrencies. It's very difficult for me today to tell you I understand exactly enough about cryptocurrencies and the blockchain to tell you how to express that theme in your portfolio profitably. Mm-hmm. The challenge for us is to take those themes and understand how to express them in the portfolio, in ADIT's portfolio, in your portfolio as one of our investor partners potentially, and have that portfolio position show positive cash flow and ultimately a path to profitability in the next 2 to 3 years, which is our criteria for making an investment. And so the themes we've chosen really, we think, are long-term secular trends for 10 years or more. They could be multi-generational themes. The cloud has been in place now for 20 or 30 years. The same people who are naysaying Jeff Bezos for putting money into AWS and Microsoft for spending money in the cloud are now cheering them for the tremendous amount of profits it's making. The shared economy theme has already begun to yield results for us. That was one of our first investments in Spotify, which we bought at $50 a share and we did a direct listing at over $166 a share. Stock's still in the $150 range, and the company continues to grow and evolve and get more and more audio visitors. It's now sort of the vanguard of podcasts, and that seems to be the next wave of information flow and a way to people to communicate about things. So the themes we chose really are long-term material themes that we think are sustainable, scalable, and we think have the effect to really profoundly change society, the economy, and the quality of life for people around the world. I think the world has changed since my father's generation. He was a Harvard Business School graduate. Peter Drucker's mentality of the corporation does what's right for shareholders. That was it. The Business Roundtable has now decided that it's much more of a holistic environment in the world today. The businesses, yes, they need to be responsive to shareholders and provide them information and good returns. They also need to be responsive to their customers and provide their customers good services, ethical business practices. And more importantly, they need to be sensitive to their community at large. People, the places they work in, their employees, and be responsible stewards of capital and responsible stewards of business, which is why on our qualitative side of our process, we have a 10-step investment process, 5 steps of which are more qualitative in nature. Things like, is it a good business? Do they have a good management team? Is it operated in an ethical, sustainable fashion with good governance, rules of governance? It's helped us stay out of investment opportunities that don't have those kinds of principles and don't have those characteristics. And it's allowed us to avoid a lot of potential mistake investments. We passed on WeWork 7 different times. We passed on Jewel on 4 different occasions. We passed on DraftKings and FanDuel and many, many other deals. We've made a total of 16 investments in our fund in our 6 years of operations. So we were very selective. We see thousands of deals every year, and we've done 2 or 3 deals a year. And we continue to be very selective. We think that's one of the value adds we bring. Because once we invest, and one of the things I learned from working with Sir John Templeton at Franklin, is the only thing we really control is the price we pay when we enter the position. We don't control the capital markets. We don't control the IPO process or the direct listing process or the sale of the business. But we do think by buying a good quality company at a fair price that's growing on its way to profitability, we'll end up generating a nice rate of return for ourselves as well as for our investor partners.
And is that why you choose to focus specifically on late stage growth companies? Because there's time to sort of see the maturation of these companies so that you can identify those characteristics that you're looking for?
Yes, it really came out as an outgrowth of our own investing. And we're trying to find companies when the question isn't if they're going to make it, it's when they get monetized, how much will it be worth? That's the difference. We're not waiting for an FDA approval to have a company be validated. We're taking existing companies that are established business models with established revenue streams on their way to scaling up to we think, very, very robust levels of profitability, good management teams, the ability to withstand competitive pressures. And essentially the data we did, some analysis on it, shows that we have a much lower failure rate. We don't want to strike out. We're not going to hit the home runs that some of the earlier stage investors might, but we're not going to have the same level of failure or strikeouts in the portfolio. We don't want to lose money. We want to basically provide people consistently quality companies that we think over time, typically our funds have a 5-year life. So over the 3 to 5 year period, we're trying to essentially get 3 times our invested capital back on each of our portfolio companies. We've done that successfully over the past 5 years. And I think that metric is still available, but it does take patience and it does take discipline in terms of what you buy, how you buy it, and how long you have to be in the position. And there's always challenges. The only guarantees in life, as you know, are death and taxes. But we do like robust growth companies. We do like companies that are disruptive and changing the world and changing the way we look at business and the world. And companies like Spotify or SpaceX or Airbnb are all characteristics of this kind of disruption. And disruption can be really good and profound. And so some of the themes that we're identifying, some of the newer themes that we're identifying in the year ahead are focused on those kinds of things. Tremendous disruption in the educational space, for example. Higher education is prohibitively expensive. There's lots of disintermediation going on there, and we think there's real opportunity there. Space, the whole space industry, we're seeing tremendous interest in exploration of space, figuring out ways, not just for space tourism, but for manufacturing in space and rare earth minerals from space and other kinds of opportunities to utilize another part of the universe to generate some interesting benefits to humans and other people, other citizens of the universe. So we're really excited about those kinds of trends. And we think that over the long term, it's like sailing with the wind at your back. This makes the ship move along a little faster and makes for a nice, much more pleasant sail and hopefully a faster destination, a faster way to get to the end of our destination on our journey to successfully returning capital to our investors with a multiple to it.
So would you say that you're able to avoid more risk by investing in late stage?
There's no question. We've worked with Cambridge Associates and some of the other consulting firms like New England Pension Consultants and other folks. Some of the people at the Oxford Said School of Business, Professor Tim Jenkins has done a lot of work. I've been at his courses and had the pleasure of working with those people. And they've defined there's definitely a lower risk element to the later stage investing. There's also potentially less upside return. You know, we're not going to buy a biotech company that's waiting for an FDA approval probably. That's not going to be one of our core positions. It's really sort of a tangential approach. We like companies that have mature business models and are growing rapidly, have the ability to scale that business model into ultimately different vertical opportunities. Palantir is a great example. They started with their data tools in the government sector. They were seeded by the Intel Q, the CIA's venture capital arm, and they went into financial services, they went into healthcare, they went into energy, into immigration reform, doing work for Airbus now in terms of logistics and parts and management of all the fleets around the world. So they've taken this data tool and expanded it now into 8 or 10 different verticals across 5 or 6 major countries. And now the company's on its way to becoming a multi-billion-dollar annual revenue with recurring revenues. And we think it's a really exciting story. So we love watching our business models evolve and grow and mature. And we think that the companies like Airbnb, which we expect to be a direct listing sometime next year, and Palantir, which we're expecting liquidity event in 2021, SpaceX, we're thinking 22, 23. As they grow and mature, they're going to become really profound elements of our society and impact the way in which we live our lives.
How do you source these companies? There are so many to choose from. How do you identify the ones that you give your serious attention and interest to?
It's a great question. And we spend a lot of time looking at a lot of companies. As I mentioned, we see thousands of opportunities every year. We have regular research meetings. We have a team internally of 8 people at ADIT, 2 on the West Coast, 8 here in New York. We've grown substantially. We continue to grow. We have an advisory board of 8 people as well, all around the globe. We have over 500 investor partners. We get ideas from all of those sources. Many of our best ideas come from our CEOs of our existing companies who are also seeing other entrepreneurial companies. But we really spend a lot of time identifying those themes we typically start small and we take a long time to make a decision in any of the companies we're investing in. And we really like to find new innovative companies that are off the radar. And so we spend a lot of time on that. I would say that our typical company source, one example is a company called Decision Sciences, which is a California-based company. It was referred to us from a former Fortune 500 CEO who's an investor partner of ours. And I met the company about 4 years ago with his introduction, and we've been a shareholder for the past 3 years. Decision Sciences uses naturally occurring atomic particles to scan the back of containers coming across our borders on trucks or coming into our ports. No X-ray, no radiation, much more accurate, much more timely. And in fact, we think they will end up with a virtual monopoly on the borders, the border crossings, the ports, and all of our military bases in the United States, as well as at all the major ports around the world. And these ideas are generated with science. They license the technology from Los Alamos Livermore Labs in New Mexico, same people who created the nuclear bomb. They're using this research to help find peaceful, productive, safe uses of these kinds of things. So really, we get ideas all over the world, all over the map. We're looking at it on a global basis because innovation, even though I grew up in Silicon Valley, my father moved us from Brooklyn, New York to Silicon Valley to go work for the very first venture capital-backed company. In 1970, he went to go work for Fairchild Semiconductor, which begat Intel and AMD and National and really changed the way investments occurred around the United States and certainly with the venture capital community. We're now seeing the same kind of innovation all over the world. Tremendous green shoots being opened up in Europe, in Latin America, in Southeast Asia. Singapore Monetary Authority, for example, is doing tremendous work in incubating ideas and interesting companies over there. In the Middle East, some of the sovereign wealth funds in the UAE are also very, very aggressively incubating ideas. We see tremendous green shoots in cities like Berlin and all over Europe. And so oftentimes the valuations of these companies in non-mainstream cities are far, far lower than they are in New York and in San Francisco or Seattle or San Diego. So we're really excited about the global approach to it, and we probably will have a global offering down the road as well. In fact, many of our successful investments, Spotify is a Luxembourg-based Swedish music streaming service. Today we own shares in Klarna, which is the largest fintech company in Europe with a $5.5 billion valuation. We've been buying it now for almost a year and really excited about that company. But again, it's a Swedish company. It came to us through our network of family office relationships overseas. And we continue to see tremendous ideas from a lot of our foreign partners. So I strongly encourage investors to come to the ADIT website. We've always got information being put up there about trends around the world. We have a thought leadership publications of 10 different white papers on various topics, be it augmented reality or virtual reality or AI or big data or healthcare. And we're publishing those things every month going forward as we can, and provide people a lot of information. And we actually have an ongoing dialogue with people. We do a couple of events a year, and we really welcome the feedback from people all over the world to give us ideas and thoughts about things to think about. It's one of the things we really enjoy. It's almost given me a renaissance of my investment career, because it's hard to teach old dogs new tricks. And this old dog gets to work with some really interesting, young, innovative, entrepreneurial companies. Exciting. I sometimes feel like I'm drinking information out of a fire hose. It's so much flow of ideas and thoughts and information that it's a challenge, but it's also invigorating and stimulating. And it's one of the favorite things that I get to do every day is to think about the world, how it's changing, how it's evolving, and the challenges we're facing. And I talk to some of the most innovative, bright, capable, thoughtful people in the world, be it on the allocation side, be it on the company side, be it on the due diligence side, the risk management side. So we're really, really excited about the opportunity set ahead and the everyday excitement of finding great companies with great entrepreneurs. It's fun.
I bet it is. But at the same time, you're very disciplined. I mean, you're invested in, I think 15 to 20 companies, 20 companies. So so it's not that you're throwing money at all these wonderful, exciting new ideas. You're very disciplined in your approach. So what makes you ready to allocate? What gives you that? When are you ready to pull the trigger and say, let's do this? Like, let's allocate now.
Yeah, that's a good question, Jen. It's a combination of factors. We have the qualitative measures I mentioned to you. We also have a series of quantitative measures. And in the quantitative side of things, we look for growth rates in terms of looking for scalable, sustainable growth. We want to see significant growth, and we want to see the ability to sustain that growth and scale that growth across the globe. We also look for things like a clear path to profitability and positive cash flow. But we use a lot of alternative techniques to measure that. So in the case of Spotify, for example, when we first invested in Spotify, Apple Music hadn't really launched yet, and Jay-Z's Tidal was thought to be a big threat. And while Spotify was in fact cash flow positive in its mature markets, they were still investing a lot of money, in R&D to identify new channels, new countries of opportunity. What we did notice is that the number of downloads of Spotify's application were far greater than that of Apple Music or any of the other competitors, which gave us the confidence to understand that ultimately the free downloads would grow into paid subscribers. And with enough free people, the freemium model to churn people, positive churn to add subscribers over time, paid subscribers, would be enough to sustain the growth rate. And we ended up doing quite well with that investment. The same kind of metrics we used with Lyft, and we saw that Lyft's number of downloads were far higher than some of their competitors, particularly when those competitors had some material bad news and some governance issues and some misogynistic behavior and some issues related to how they treated their drivers. All of a sudden, we became very comfortable and confident that Lyft would, in fact, outperform its larger competitors, and what's more focused approach became clear to us. So we use a variety of different metrics to identify the timing. Ideally, we buy the company right as it's beginning to scale in the J curve. The reason we buy, in many cases, about half the time we're buying secondary shares, we want to shorten that J curve. Rather than owning it for 7 years and then seeing the growth, we'd like to own it for 7 or 8 months and then see the growth prior to a catalyst. And that catalyst might be a growth equity round that gives them capital to go out and expand their marketing, to go into new countries, as Palantir has in Japan, as Spotify did by penetrating other markets, be it overseas or be it in Korea or Japan in Spotify's case. So those are the kind of things we look for. But it's a combination of the qualitative and the quantitative values we bring to bear in conjunction with having the right price, the right cost basis to enter the transaction. Ideally, we can buy the transaction at a slight discount to the last round. That gives us a margin of safety, as our good friend Seth Klarman might say in his hedge fund. And we're buying at a cheap enough price, we can wait, get paid while we wait for the value of the company to be compounded by their profitability, their growth rate, the future prospect for profits, and higher growth rates in terms of revenues. So that's sort of the combination. It's a very subjective process in terms of understanding management teams. We always meet with a management team face to face. We go do a physical visit to their offices. We'd like to get to know the companies very, very well. We're not often getting board seats. We don't own control of these companies. We're minority investors. We do demand information rights on the companies. Sometimes that's formal in terms of buying a preferred shares. Sometimes it's an informal process. But we have to have information going in. Again, there's no guarantees in life other than death and taxes. But if we have the facts and we're able to share the facts with our investors, at least we're going into the investment with our eyes wide open. And that's the minimum requirement for us. We do think it's very important to be disciplined, though. We're not going to be an index fund. We think there's going to be some big winners and there's going to be some big dislocations, and therefore some companies that will lose market share and not be successful. I have on my wall in my study at home, I have copies of stock certificates from A&P stores and from Chrysler Corporation and from companies like Xerox and Kodak, which were the highest tech leading edge companies in their eras and now don't exist. And so therefore, or are a fraction of them former selves in terms of what they have in terms of proprietary technologies and business models. So it's a very humbling experience to be at the vanguard of technology and services and emerging growth companies. You have to be nimble, you have to be honest and humble, and you have to work very, very hard. And we work really hard to try to keep ourselves abreast of what's happening in a lot of the trends. We're speaking at over 20 conferences next year. We attend over 50 conferences. I'm on the road about a third of my time. I just got back from Europe, the Nordic countries, and the Middle East. I'm headed to Asia in the first half of next year. And we travel extensively. And we think that by getting that perspective from people around the world, it makes us better investors. By getting the hard questions from smart reporters like yourself and other journalists and other investors, it makes us better investors because they challenge our assumptions. And we have to verify, confirm, and rationalize the assumptions we've made, the decisions we've made, and the premises we're basing our themes on. And that to us is a very helpful, albeit sometimes humbling process to make sure that we're doing things in a thoughtful, mindful, logical, and hopefully ultimately successful fashion.
And you mentioned that in your Q4 2019 IPO market update, you said that ADIT avoids companies that, quote, don't behave, companies that are less responsible. So how do you dodge the bullets that you've dodged? How do you avoid the bad apples?
Yeah. You know, it's again, a very subjective process. We believe good governance is good business, full stop. And by companies that are good stewards, they represent their community, they support their customers, their employees, and they make the world as a better place in general. Those are the kind of companies we want to be involved in. Alternatively, we didn't like to be involved in companies. We don't like to be involved in companies that are providing a good or a service which may or may not be a positive to the world. We felt very clearly that the FanDuel, DraftKings would be under severe regulatory scrutiny, and that gambling, while it be a good revenue source potentially for the state of New Jersey or Nevada, or ultimately it'll be a national kind of allow sports gambling, that wasn't necessarily an activity that we felt we should be embracing and endorsing. Not that we're judging it, but in terms of making the world a better place, sports gambling or other kinds of gambling is not going to improve quality of life for people around the world. It might make the states some money, and that may be helpful, but not something that's going to change society for the better. Same is true with the vaping company, Juul. When we passed on that deal the first two times, and then Philip Morris invested in the company, we left $14 million on the table. And my son made me aware of that when he told me that we left $14 million on the table. My mother passed away from lung cancer and symptoms of it. And I just was not comfortable investing in a company that was, albeit trying to be healthier, and that was the spin that they were having on the vaping consumption business for having tobacco, not smoking. I still didn't feel that that was necessarily a huge contributor to society. And ultimately, those health claims are what's creating the backlash from regulators. And I just think that that's an important discipline to have, that we're trying to focus And not that we're morally taking the high road. The same thing can be true of companies that are not as environmentally friendly. They're not focused on sustainable business practices. It makes good business sense to be focused on sustainability and on good governance, in our opinion. I rewrote the Sierra Club's Legal Defense Fund investment policy statement now almost 35 years ago, when before their only option when they were given stocks from some of their donors, they would just sell the companies and walk away, almost like an ostrich putting its head in the sand. And I made the case to the board, look, that's one way to go. You can sell those companies and divest them and focus on the companies that are the good actors. I said, alternatively, you can embrace the system. And as a shareholder of Exxon or Chevron, you can put your shareholder initiatives on the ballot and therefore have a voice to be an activist and help the company understand that you want them to change their behavior. And I think it's very clear now that society wants companies to change the bad behavior. And as a consequence, they're going to punish those companies in terms of rules and regulations, but more importantly, in terms of the valuation of the business. The market is already discounting the bad actors, bad governance, bad practices. And by doing that, we think we're focusing on good practices and better companies that will get better valuations because of these principles of being environmentally sustainable and sound. By having sustainability practices across their entire ecosystem, and more importantly, having good governance rules. So as they meet regulatory challenges, competitive challenges, have to deal with conflicts which inevitably occur in a business between providing for your employees, providing for your community, and providing for your shareholders, there's a process to understand every part of the equation and do the right thing. So it's not easy to be a CEO these days. We get that. But we also think it's important, and there's a responsibility there. It's not just about the corporation making maximum profits and everyone taking their money and living happily ever after. There's an element these days of making the world a better place, which we think is a very important part of any investment process.
So would you say that those corporate governance factors are what help you build trust in a company, regardless of what you think about the founder or specific people? Would you say that that's how you build trust in an organization, is those factors? How do you build trust in a company?
Yeah, well, that's a great question. Building trust with a management team and trusting in the company's business model is a very complex and involved process. Our typical diligence process gets us through the initial part of it. But one of the most important things is the values of the CEO and of the board and of the company. And by having shared values, things that are important on a global macro kind of approach, it allows us to meet the individual challenges, whatever they may be, in business, in society, with your employees, with your community, with environmental issues, with sustainability issues maybe. And by having that overall shared values, we get more comfortable with the process. There's always going to be challenges in any businesses. They have to pivot. Facebook had challenges. Google had challenges. Apple Computer almost went bankrupt a couple of times in its history. I had the pleasure of working on the Apple IPO way back when, and I've seen the company go up and down. And obviously the company today is one of the largest market cap companies in the world, if not the largest market cap company in the world. But they had to pivot several times. Every business has to make tough decisions. If they use their shared values in aggregate, as a board, as a team of executives, as a business, those shared values send a message to the investment community, to your customer base, and to the overall world that you're this kind of company. And we want to focus on the companies that are trying to make the world a better place, trying to make their businesses more efficient, more profitable, more sustainable, more focused on serving their customers, their clients, their employees, as well as their community at large. And that holistic approach, I think, and those shared values are what helps us build an understanding and a trust in the management team and the business. One of the reasons we passed on Uber was the fact we didn't feel the governance was very strong. Now they've got a new management team in place. They're in the process, I think, of changing that culture and making it a much better business model and a much better company. But it's a very large business, and it's going to take them years to turn that around, as it has so far. We chose Lyft because it had better governance. It was the first one to do employee benefits, training, provide childcare, to do the carbon offset footprint on all of their rides. It's now become industry standards, many of those things. Tipping for their employees. That was a Lyft innovation. So we are very comfortable with the values that management team put forth. We're comfortable and trust that they will be executing towards profitability at a far better pace than their larger competitors around the world. So that's the reason we made those decisions. So yes, we definitely focus on those kinds of shared values to enable us to have a level of trust in the management team. It's very important to us.
So what's a common mistake that these late stage growth companies make in the process of trying to attract additional capital?
Well, I think there's mistakes that the companies make and there's mistakes that investors make when they try to select those companies. We'll talk a little bit about both if we could.
Yep.
The companies themselves oftentimes get into what I call a process of diversification. They may have a really nice business model here, and then they get a wild idea. So in the case of Lyft and Uber, their idea, let's own scooter companies. Let's buy the bike companies to give us that last mile of connectivity. Those companies and those industries, the scooter business, the bike business, while they've been around for a while, they're not commercially viable. They're far earlier in their genesis than the ride-sharing business, which could be traced back to taxis and chariots back in the Roman days, for that matter. Ride-sharing has been going on for a long time, just as Airbnb's lodging model, having people sleep on your couch or share in a guest bedroom, has been around for thousands and thousands of years. What's changed in the ride-sharing business is Lyft and to a lesser extent Uber have figured out ways to use GPS and other kinds of technology to make it much easier for you and I to get a taxi or a ride from here to there, and much more affordable. We think that the principles of those ideas are really important. And I think that getting excited about those kinds of spaces is really important. So I think that for a lot of reasons, we avoid the problem issues because of those kinds of disciplines we bring to the process.
And so what types of, you've probably reviewed thousands of pitches. What are the ones that stand out to you? What impresses you?
Well, I think you have to have a clear, concise story. You need to be able to tell the story in a matter of minutes, frankly. You can look at a business and understand the basic tenets, 3, 4, 5, 6 things that make you unique and special, what you bring your edge in terms of what you can do that other people cannot, what you do which is proprietary, what you think is important, what values you bring to the business, to the economy, to the marketplace, to the community at large. And those are the kind of things that have to resonate for us. We've seen a lot of people get distracted with jargon words, cloud, cyber, AI, machine learning, blah, blah, blah. But there's no, as they say in Texas, it's all hat and no cattle. We want to see the cattle. We want to see where's the beef, as Clara Bell said way back when in the Burger King ads. And we want to see where's the beef. What's their secret sauce to have their product, their service, their whatever it may be, resonate with consumers, resonate with customers, resonate with their employees, resonate with the community at large, be it the investment community, the venture community, or the public markets at large. Those are really important concepts and really important things. And it's surprising how often people get distracted. I was talking to a gentleman who had a really cool technology related to blockchain on super secure communications. And he kept going off about this cryptocurrency token that he had done 6 years ago related to the business. And I said, look, I understand you did this transaction 6 years ago in your business, but the cryptocurrency token has nothing to do with your core technology capabilities and in fact, your business model going forward. Because that token was 6 years ago, your future is ahead in this encrypted kind of technology. Focus on the story. Oftentimes we get all wrapped up in, it's the holiday times, everyone looks at the package, how it's wrapped, rather than what's inside the package and how to utilize the toy, the sweater, whatever, the food in the package, whatever it might be. So we like to get through the packaging and get down to the core essential element of what the service or the good is of the particular company. And oftentimes companies make mistakes by diffusing their messaging, by wrapping it in too many times of wrappers to appeal to people. Right now, there's this massive wave of money going after green investing and ESG, and many of the people who are leading those funds do not have the qualifications to be good investors, and they're wrapping themselves in that blanket just to sort of attract assets rather than really do the work and really make sustainability and ESG principles or whatever principles they're using a primary driver. They're really just using it as a marketing tool.
Mm-hmm.
We want to avoid those kinds of hype situations. Oftentimes, the mistakes that investors make, they just buy the largest cap companies across any marketplace, assuming that these are the big guys and they're going to go public and be successful. That doesn't work. It didn't work for WeWork. It didn't work that well for Uber. It has not worked historically over things. You need to figure out the right companies to buy and the right price to buy them at. It's not rocket science, although we do own some rocket science companies. And in fact, we put that into our documents. In fact, the last sentence in one of our SpaceX documents is, there can be no assurances that management of ADIT nor of the target company, SpaceX, will achieve its objectives, because after all, this is in fact rocket science. And there are no guarantees, but we think that people like that who are smart and work hard and are relentless in their approach will ultimately overcome the challenges, overcome the failures, and be successful in putting astronauts back in space, in potentially using space as a tool to mine rare earth minerals or manufacture things in a clean room environment without gravity. These are the kinds of applications that we think have far-reaching consequences and ultimately would drive the valuation of SpaceX and other satellite and space-related companies much, much higher over time.
So just to go back for just a second, that comment you made about market capitalization, would you say that that's the biggest thing that investors overestimate? What do they underestimate in the process of reviewing late-stage companies, typically, that you see?
Well, I think that investors need to really understand the business model. They need to do the homework. There's no shortcuts in life. In my opinion, life is about hard work. It's about struggle. It's about the human spirit overcoming adversity and challenge. That's true in an individual's life. That's true in a student's life. That's true in a baby's life. It's true in an investor's life. It's true in a company's life. Every company has to overcome adversity and failure. We mentioned a number of them like Apple and Amazon and Google, Facebook. Some of the largest companies in the world have all faced existential challenges in their lives. By being able to have the values that they did, bring a management team together to overcome those challenges, be it competitive challenges, technological challenges, societal challenges, regulatory challenges, they're able to overcome those challenges. Investors need to differentiate the hype between the facts. You need to have realistic assumptions about what the growth rate of a company might be, what the penetration of a service or a good may be across different marketplaces, and understand that companies need to invest capital to grow their businesses, and that it's not an instantaneous payout. This is not putting a chip on red and getting paid every time the bell rings. Sometimes it works, sometimes it doesn't. Companies that are well managed and well governed have a better chance, in our opinion, of being consistently successful in growing their business, in investing in their businesses, investing in their employees, investing in their partners. But I think investors need to focus on the facts. And right now, there's a tremendous amount of misinformation in the world about companies. One of the advantages in the privately held marketplace is that there is a distinct informational edge. Those people who have the information, we like to follow those folks who are the top quartile performing venture capital managers. We look at a lot of early stage investment flows to understand where the smart money is allocating capital. Much like people follow Warren Buffett in the public markets, we follow the smart money in the private markets. What we found, thanks to Tim Jenkins and many of the people at Oxford, is that there is a persistence of repeatable top quartile results among a certain number of these top quartile venture managers, about a dozen firms we follow. That persistence does not exist in any other asset class, not in hedge funds, not in mutual funds, not in all long-only managers, not in buyout funds. not in other private equity asset classes, but in venture capital, there's a group of managers who have the right ecosystem. They have enough capital, they have the right HR people, enough pool of executives, they have enough resources at those firms to identify the trends, the marketplaces, and the companies to back. And they've got a consistent 20 to 30-year track record of doing that. We like to follow that smart money and allocate our monies to those kinds of names as they get to be more successful. We like to do it rather than spend 10 or 15 years, try to do it within 3 to 5 years in our portfolio. We have a 5-year life in our typical portfolio. And we like to get paid while we wait. So it's an interesting process for us, and it's always challenging. It's always a lot of fun. But it does require us to look and say no a lot. And I think individual investors need to do their work and understand that, yes, you need to have a 3 to 5 year time horizon in the private markets. There is no free lunch. If someone's offering you instantaneous overnight success, look hard at that and question those assumptions. Look at the downside risk. We like to have asymmetrical returns. We like to follow these smart money venture investors and some select corporate venture capital investors, which have become very, very large in the last decade or so. The rise of corporate venture capital is a trend that we're speaking on in a number of conferences going forward. But they're oftentimes 30 to 40% of these rounds. And they can become the exit strategy. In fact, 70% of our positions we expect to be purchased by a strategic investor or another acquirer of some sort who's looking for that growth to be incorporated into their business model. There's $1.5 trillion of dry powder in venture capital right now. That money needs to be put to work. You're going to see more and more deals get taken from one sponsor to another. Mm-hmm. You've seen that happen already in the SaaS space, software as a service space, with Vista Equity Partners and Thoma Bravo being very active in the space. Multiple $3 to $5 billion deals happening all over the map. And right now, we think M&A is going to drive things going forward, and perhaps even more so than the IPO market for the next decade ahead. Because you've got low interest rates, low cost of capital, a need to grow the businesses and put up some sustainable growth rates. And more firms, we think, will be doing that going forward.
And so what role does transparency play at this stage of the game when you're looking at late stage growth companies? Are they fairly transparent to you when communicating about some of the hurdles that they have to overcome and say, we've encountered X, but here's how we're dealing with it? Is that typical or non-typical?
It really depends on the company. I would say that transparency is essential for us to have some level of transparency. At a minimum, we get financial information about the company and their business. Sometimes it's delayed, 3 months or 6 months from the typical board meeting. We don't need to have it real time. We're not trying to micromanage the business. As long as we have access to information, it gives us enough information to make good investment decisions on the company and to allow us to share that information on an as-needed basis with our investor partners. That's essential for us. I think that companies who are transparent, who do communicate well with the investment community, with their customer base, with their shareholders, are better governed, and we think them, therefore, are more attractive to us, and ultimately we think will become more valuable as investments to us. So in that kind of approach, we think transparency is essential. Most companies have a mixed bag on transparency. They want to provide some information, but they also want to keep part of what they're doing secret because they're still privately held, and they want to have a competitive edge against some of their other folks. And so it's an interesting process, but transparency is an essential step for us, yes.
Mm-hmm. And so what's the number one thing you would advise a late stage growth company to do before they contact or present to you?
Well, for us, we need to have a general understanding of their business. We'd like them to present to us their information in a concise, professional, clear fashion. We'd like to have some transparency on their financials, on their board, on their cap table, and on their plans going forward. What ADIT does, before we make any investments, we do our own, create our own 5-year pro forma financial, do our own projections on a business, and make sure that we're comfortable with those things going forward. And that's an essential part of our process. So we need to get that kind of information in our hands and really understand how they will challenge the conventional wisdom, the conventional market opportunities, and how they'll respond to competitive challenges going forward. Margin pressure, inflationary pressures, cost of capital, what their decision might be on a public offering or a sale of the business. Those kinds of important strategic decisions are very important for us to understand their values and their thought process behind how they would manage those things. And that's sort of the beginning of an understanding and the beginning of establishing some level of trust in the management team to execute on their strategy and on their vision. Ultimately, the vision that they have and the capability of the team to execute that vision is what defines success, in my opinion, of a growth company.
Right, that's very important. So lastly, what are you looking forward to next year as we approach the new year?
I'm super excited about the year ahead. We've had the mobile phone platform, it's our little handheld computer. We think that's going to be, we're going to be into a whole new paradigm shift. You're seeing now with the advent of the 5G networks, of the machine learning tools and all the big data tools, gathering information to actually make artificial intelligence and deep learning, machine learning stuff actually become very helpful and mainstream for us in our daily lives, be it traffic patterns or financial information or other kinds of things. We think that AI and augmented reality and virtual reality will be hugely prevalent in the decade ahead. I think the whole concept of computers serving us and us being able to use voice actuation. I mean, with all due respect to Siri and Alexa and some of the current technologies, how many times have you talked to Siri and asked her a question and you get no response or the wrong response? We can't really rely on her at this point, nor Alexa. But I think in the next decade ahead, we will be doing a lot more with facial recognition or eye recognition or voice recognition. And it'll be much easier, instead of having the DOS commands that were so difficult for people to learn or other computer languages. Computers will be there to serve us. The data tools will be there to serve us. We think there's going to be tremendous interest still in cybersecurity. Probably the next kind of terrorism attacks we're seeing are not going to be nuclear bombs or people blowing up buildings with planes, but cyber terrorism is probably a much more likely source. I think you'll see tremendous changes in the healthcare system, in the transportation systems, in the use of energy, in the management of the energy grid. In industries like logistics, when you've got bills of lading, major ships coming into ports, and instead of being digitized, it's pieces of paper with a 25-ton ship coming into a dock in a port. My God, let's get some digital records here and understand what's in there. So all of these kinds of industries that have been in the dark ages and have not been digitized and organized, and logistics and transportation, energy, all of these kinds of things we think have tremendous changes ahead. Healthcare is almost 30% of the economy. There's going to be profound changes in our whole economic system. So I'm really excited about the decade ahead. I think you're going to see people be pleasantly surprised by a lot of the near-term catalysts. I think ultimately there is a moral compass, and I think that the globe is going to be a better place 10 years from today than it is today, and people will feel more confident and more in control because of the information tools they have, because of the data they can pull and understand, and because of the tools they'll have to understand things going forward. So we are really very optimistic about the names in our portfolio and about a lot of things going forward. So I'm really optimistic and really excited about the new decade ahead, and can't wait to see what happens. And I look forward to having a conversation again with you a year from now, 2 years from now, 5 years from now, to look back and see if some of the things that we're talking about. I will be releasing our quarterly letter the week of January 16th with our 10 surprises in the decade ahead, potential surprises. And I'll be happy to share those ideas with you later on in the year ahead.
Great. I look forward to that. And you're so right. I mean, it'll be amazing to see what develops in the coming year and in the next decade. It's amazing how quickly things do develop. So yeah, there's a lot to look forward to. So thank you so much for your time today, Eric. I really appreciate all of your insights. So those capital seekers out there will really get a good understanding of what's important today as far as attracting capital.
Absolutely. The only constant is change. So enjoy, happy investing, have a wonderful holiday, happy new year, and we'll see you in the decade ahead.
Okay. Thank you so much, Eric.
Thank you, Jennifer. Thank you. Take care.